Is the U.S. really headed for a recession? You probably noticed the stock market taking a significant dive recently amid fears of an imminent U.S. recession, and the media had an absolute field day with this news. It's a clickable subject. People are drawn to negative news, especially when it concerns a potential U.S. recession. But is their panic justified? Let's cut through the noise and explore the real risks. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. A recession is generally defined as a significant decline in economic activity that persists for several months. This downturn can be triggered by various factors, including inflation, when prices rise and the dollar becomes weaker, deflation, when prices fall and the dollar purchases more, or high interest rates. These issues often lead to higher unemployment, decreased consumer confidence, foreclosures, and business bankruptcies. As a result, the stock market typically experiences a sharp decline as investors panic and withdraw their funds. Goldman Sachs and J.P. Morgan have both increased their estimates of a U.S. recession, with J.P. Morgan CEO Jamie Dimon predicting a probability as high as 40%. The latest figures show Goldman Sachs at 25% and J.P. Morgan at 35%. With recent weak jobs data, rising unemployment, and persistent inflation, coupled with high interest rates, the U.S. economy is facing growing risks of a recession. But what does this mean for you and me as individual investors? Ignoring the potential for economic downturns can be a risky gamble. It's easy to become complacent during periods of prosperity, but the consequences of being unprepared can be severe. While the prospect of an economic downturn can be unsettling, there are strategies to help you navigate these turbulent times. Economic downturns can also offer unique opportunities for those with a strong financial foundation. One crucial habit for financial success, regardless of economic conditions, is to live below your means. The difference between your income and expenses is what fuels investments and debt repayment. Unfortunately, many people fall into the trap of matching their spending to their income, leading to a constant struggle. When they receive a raise, it's often used for a new car or a larger home. Tax refunds are quickly spent on vacations. While living below your means might sound restrictive, it can lead to significant positive changes in your life. Did you know that the average millionaire has 7 sources of income? By diversifying their income, they reduce their reliance on a single job and minimize financial worries. Combining this with a frugal lifestyle can provide a strong financial foundation, even during challenging times. One of the greatest benefits of multiple income streams is the potential for one to take off. For example, someone working a 9-to-5 job might start a side hustle detailing cars. If successful, this side hustle could become a more lucrative primary income source, allowing them to quit their full-time job and enjoy a significant increase in earnings. Paying off debt isn't always the best financial strategy. It's generally advisable to prioritize high-interest debt while making minimum payments on low-interest debt. Instead of aggressively paying off low-interest loans, consider investing the extra money if it can earn a higher return than the interest rate on the debt. While this makes sense mathematically, it's important to remember that having little or no debt can significantly reduce your monthly expenses. This can provide a financial safety net during economic downturns and improve your overall peace of mind. How many purchases have you regretted? A brand new car that's now dented and unreliable, a timeshare that was a vacation pitch, or an extravagant wedding with an ex-spouse. These expensive items can be worthwhile if they bring happiness. However, the problem arises when people impulsively make purchases, large or small. Wasting money on unnecessary items can drain your wallet, especially during financial hardships like job loss or market crashes. By carefully considering each purchase, you'll appreciate your money more and enjoy lasting satisfaction. Market crashes and recessions can feel like the end of the world. However, it's important to remember that these events are a normal part of the economic cycle. Recessions occur about every 4 years, lasting around a year and a half. Bear markets, where stocks drop at least 20%, happen about every 3.5 years and typically last 9 to 10 months. While it's unsettling to see your investments lose value, especially as you age, understanding these patterns can make it easier to cope. By preparing your portfolio for downturns and avoiding excessive leverage, you can navigate these challenging times with greater confidence. Remember, markets are cyclical, and with the right approach, you can weather these storms and emerge stronger. Economic downturns often present lucrative investment opportunities. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Investors who can capitalize on discounted assets can reap significant rewards when these assets recover. Buying the dip aligns with the fundamental investment principle of buy low, sell high. While perfectly timing the market can be challenging, purchasing stocks during a sharp price decline and holding them for the long term can be a profitable strategy. However, this approach does require sufficient capital to withstand any potential losses. It's easy to forget past recessions, especially for younger generations. During periods of economic prosperity, these events can seem like distant memories. Don't let complacency blind you to the risks. By remembering these times and preparing for potential future recessions, you can protect your financial future and seize opportunities when they arise.